On June 16th, Alibaba was trading near $130. 11 days later, it's sitting around 95. That's roughly a 27% drop in less than 2 weeks. And the stock just touched a fresh 52-week low. Here's the part that should actually stop you. As of this recording, the large majority of analysts covering the stock still rated a buy, with average price targets somewhere between $175 and $195, depending on which firm you ask, and that consensus moves week to week. So treat these as a snapshot, not a fixed number. Even at the lower end of that range, a $95 stock sitting against a $175 target means a market is pricing this somewhere around half of what most professional analysts currently think it's worth. So either Wall Street is about to look very wrong, or the market is pricing in something analysts haven't fully priced in yet. By the end of this video, you'll understand exactly what that something is. Because there isn't just one reason the stock is falling. There are four, and they hit in the same 2-week window. Marcus. Okay, that's a big gap. What actually happened? Priya. Let's go through in order, because the order matters here. The first thing happened on June 8th. The U.S. Department of Defense added Alibaba to something called the Section 1260H list. This is a list created under a 2021 defense law of companies the Pentagon believes are connected to China's military through what Washington calls military-civil fusion. Alibaba was added alongside Baidu and BYD, bringing the total list to 188 companies. Marcus. Does that actually mean anything legally? Or is it just a label? Priya. It's somewhere in between, and that's actually the uncomfortable part for investors. Being on the list doesn't freeze assets and doesn't impose sanctions automatically. But starting June 30th, a statutory provision bars the Pentagon from new procurement contracts with listed companies. And there's a second provision that's arguably more damaging. The restriction extends to any U.S. contractor or law firm that also represents a listed company. Alibaba said in its lawsuit that this is already forcing some of its longtime American lobbyists and lawyers to consider cutting ties, specifically because representing Alibaba could now cost them defense-related business elsewhere. Marcus. So Alibaba is fighting back? Priya. On June 23rd, Alibaba filed a federal lawsuit in California against the Department of Defense, calling the designation, in the company's own words, arbitrary and without basis in fact or law. Alibaba says it spent months providing evidence to the Pentagon that none of its independent board members have military affiliations, and that the Department of Defense never responded to that evidence. This is an unprecedented. Xiaomi successfully sued its way off a similar list in the past, after obtaining a preliminary injunction from a federal judge. Wuxi AppTech filed a nearly identical lawsuit just weeks before Alibaba did. So there's a real legal path here, but it takes time, and markets generally don't like uncertainty while a case plays out in federal court. Now here's the second thing, and this one is genuinely more serious for stock, because it's not about geopolitics. It's about a direct accusation from an American AI company. On June 10th, Anthropic, the company behind the Claude AI models, sent a letter to the Senate Banking Committee accusing accounts it believes were connected to Alibaba's QuantAI lab, or what Anthropic called the largest known distillation attack on its systems to date. Marcus. What is a distillation attack exactly? Priya. First, it's worth separating the technique from the accusation, because this gets misunderstood constantly. Model distillation itself is a completely legitimate, widely used machine learning technique. Plenty of companies use it legally to train smaller, cheaper models from larger ones they own or have proper access to. What Anthropic is alleging here isn't that distillation happened. It's that it happened without authorization, through fraudulent accounts designed to bypass access restrictions. That's the actual accusation, and it's a meaningfully different claim than this technique is inherently malicious. Mechanically, here's what the technique involves. You repeatedly query a more advanced AI model and use its responses to train a separate, smaller model to mimic its behavior without ever accessing the original model's actual code or internal weights. Think of it like an art student going to a museum every single day, not to copy a painting brushstroke by brushstroke, but to study thousands of paintings closely enough to eventually paint in a similar style themselves. Do that legally with permission, and it's just machine learning. Do it through fake accounts designed to dodge access restrictions, And that's the allegation Anthropic is making here. According to Anthropic's letter, the campaign ran from April 22nd to June 5th and generated more than 28.8 million interactions with Claude through close to 25,000 fraudulent accounts, using proxy services specifically to get around the geographic restrictions that block access from China. Anthropic says the targeted capabilities were Claude's most advanced software engineering and reasoning functions. Marcus, has this been proven in court, or is this still just an accusation? Priya, that distinction matters, and I want to be precise about it because it's the difference between a confirmed fact and an open allegation. As of right now, this is Anthropic's claim, made in a letter to lawmakers, not a finding from a court or a regulator. Alibaba has not publicly responded to the specific allegations, and as of this recording, the letter has not resulted in any formal enforcement action against Alibaba. Anthropic says its own evidence points to coordinated activity connected to accounts associated with Quen, but that's Anthropic's characterization of its evidence, not an independent or judicial finding, and it doesn't equal a confirmed admission of direct corporate involvement. What we can say with certainty is that the letter was sent, the numbers in it are specific and documented, and it landed 2 days before the Commerce Department issued new export restrictions on Anthropic's own most advanced models, which is its own separate story entirely. What matters for your money is simpler. The market doesn't wait for a verdict. The day this became public, Alibaba stock dropped nearly 3% in a single session, and it added another layer of risk on top of stock that was already under pressure. Marcus. So that's two separate problems hitting at the same time. A military list and an AI accusation. Priya. And neither of those is actually about whether Alibaba's underlying business is doing well or poorly. That's the third piece, and it's the one long-term investors should weight the most heavily, because it's about fundamentals, not headlines. China just finished its 618 Shopping Festival, one of the two biggest shopping events of the year, running from mid-May through June 18th, according to data tracking firm Cinton. Total sales across all major platforms combined grew by roughly 1% year over year. According to that same firm, last year's festival grew by about 15%, though other research firms tracking the same event report somewhat different growth figures. So treat these as directionally accurate rather than exact across every source. Marcus, that's a massive slowdown. Is that just an Alibaba problem? Priya, no. And this is important because if I told you Alibaba specifically had a bad festival, that would actually be misleading. The slowdown hit the entire Chinese e-commerce industry. What's notable is who didn't slow down. Douyin and Pinduoduo, Alibaba's two biggest rivals, posted GMV growth roughly in the 20 to 30% range during the same period according to multiple market trackers, with exact figures varying by source, even as the overall festival barely grew. Tmall, Alibaba's flagship platform, remained the single largest platform by total sales according to Cinton, but the growth gap between Alibaba and its fastest-growing competitors is now wide enough that analysts at firms like Daiwa cut their price targets, specifically citing that competitive pressure. Daiwa moved its target from $200 down to $175, while still keeping a buy rating. Marcus. So even the bullish analysts are getting a little more cautious. Priya. That's exactly the right way to frame it. Nobody serious is calling this a collapse of the business. They're calling it a deceleration and a competitive challenge from companies built around short video and ultra-low pricing that didn't really exist at the scale 5 years ago. Now for the fourth piece, and this one is about money Alibaba is spending, not money it's losing to competitors. Alibaba has committed to spending more than 380 billion yuan, around 56 billion US dollars, on AI infrastructure over the next 3 years. In its most recent fiscal year, the company posted its first operating loss since early 2021, an operating loss of 848 million yuan for the quarter, and weak free cash flow, driven largely by that AI spending alongside continued investment in low-margin quick commerce delivery. Marcus, is that a bad sign, or is that just what every tech company is doing right now? Priya, genuinely, it's the second one, and it's worth saying clearly. Every major technology company on Earth right now, American or Chinese, is spending an enormous amount of capital on AI infrastructure because the companies that don't build capacity now risk being locked out of the next decade of cloud and AI revenue entirely. And before anyone assumes the spending is putting the company at risk, it's worth grounding this in the balance sheet. As of the most recent quarter, Alibaba held approximately $38 billion in net cash. Management has also explicitly characterized the spending as a deliberate, planned investment cycle rather than a sign of distress, telling analysts on the earnings call that the pattern is intentional given what they view as a critical window in AI. Alibaba's cloud division, the part of the business most tied to the spending, is reportedly forecast to have AI-related services account for more than half of its cloud revenue within the next year, which suggests the spending is at least connecting to real demand, not just being poured into speculative infrastructure. The honest risk isn't that the spending is foolish or that the company is running low on cash. It's that heavy capital spending plus a slowing core e-commerce business plus two separate geopolitical and legal disputes is a lot of simultaneous pressure for one stock to absorb at once. And the market is currently pricing in the pressure more than the long-term plan. So, let's go back to where we started. A large majority of buy ratings against a small handful of holds or sells. As of this recording, average targets near $190 against a stock trading near $95. That gap exists for a specific reason. And once you understand it, it actually makes sense rather than looking like a contradiction. Wall Street analysts build models around multi-year fundamentals. Cloud growth rates, AI monetization timelines, e-commerce margins. On those measures, most analysts still see real value here, and Alibaba trades at a forward earnings multiple in the mid-teens, roughly half of Amazon's forward multiple, despite operating one of the largest cloud businesses in Asia. That gap exists even before factoring in the legal and geopolitical overhang, which is exactly the kind of valuation disconnect that tends to draw in value-focused investors, while also making the stock more sensitive to bad headlines than a richly valued growth stock would be. The market, in the short term, is pricing in something analyst models are built to look past, which is acute, immediate uncertainty. A federal lawsuit with an unknown timeline. A serious, unresolved accusation from a major AI lab. A competitive threat that's measurable today, this quarter, not 5 years from now. Marcus. So which one is actually right? Priya. That's the honest answer nobody can give you with certainty right now. And anyone who tells you otherwise is selling you confidence the situation doesn't support yet. If the lawsuit resolves in Alibaba's favor, the way Xiaomi's did, that's one real risk removed from the stock. If the distillation allegations stay an unresolved accusation, rather than escalating into confirmed enforcement action, that pressure eases too. If Alibaba's cloud and AI investments start showing up in margins over the next 2 or 3 quarters, the competitive pressure story changes. Those are 3 separate, genuinely uncertain threads, and the stock price right now reflects uncertainty on all 3 at once, while analyst price targets mostly reflect a future where most of that uncertainty resolves cleanly. What you should actually watch instead of the daily headlines is straightforward. Watch what happens procedurally with the federal lawsuit over the summer. Watch whether Anthropic's allegations move toward any kind of formal enforcement action or stay as a one-time letter to Congress. And watch Alibaba's next earnings report for cloud growth and margin trends, because that single report will tell you more about whether this is a temporary scare or a real structural shift than anything in this week's stock chart. If breakdowns like this, the kind that separates a headline from the fundamentals, are useful to you, subscribe, because we'll be tracking exactly how each of these threads resolves as the real data comes in.